Pretiorates Thoughts 73. Gold is king, but silver could now become the champion. Gold has easily broken through the 3,000 mark and has been consolidating just above it for a few days now. The fact that the price did not fall back below it can be interpreted as a sign of strength. As always, however, we distinguish between trading in the Western Hemisphere, which is strongly dominated by paper gold. This includes futures, ETFs, and all structural financial products. In Eastern trading, especially in India and China, the focus is more on the physical metal. Our Smart Investors Action Indicator tracks the behavior of big investors as they significantly influence index movements. By isolating their activities, we create a new price curve. The light blue area highlights the difference from the actual price development. An upward move signals accumulation, bullish, while a downward move indicates selling, bearish. Red areas mark high-volume phases, which we call exaggerations. The stronger they are, the higher the likelihood of a reversal, especially when a yellow dot appears, signaling a key exaggeration point. If we observe the Smart Investors Action in London and the US, they have recently distributed massively in the rising market. The financial markets focus on the future. That is why emotions such as hope and fear are particularly important. New investments are especially promising if you have the courage to enter during pessimistic moments. You should sell investments when optimism is very high. This is the case when the light blue area rises sharply. If it falls sharply, pessimism is very high, which often offers good buying opportunities. Surprisingly, the market showed not optimism, but deep pessimism. Western investors do not believe in a further rising gold price. In contrast, smart investors in the Eastern markets have accumulated massively, and this to an extent that we have not seen in the last 10 months. During the consolidation of the last few weeks below the 3,000 mark, sentiment also showed a slight reluctance, but this has since turned into optimism again. The same assets are usually traded at the same price on different exchanges. However, if there is a price difference, an arbitrage opportunity arises, which is immediately exploited. Due to capital controls in China, this arbitrage opportunity is more difficult. The price difference thus provides a very good insight into the strength of interest in gold and silver in the Chinese market. This chart shows the percentage price differences between Shanghai and Western markets. At this moment, the market price still does not reflect a premium to trading in the West. Purchases in China are therefore being made cautiously and patiently. The premium in silver trading has also fallen sharply recently. Currently, a premium of around 5% is still being paid for physical silver in China, in contrast to over 15% a year ago. The price of an ETF is exactly the same as that of the physical metal. When investor interest in gold ETFs grows, the ETF's market maker increases the number of ETFs. The number of ETFs issued is therefore a very good indication of investor interest. In China, too, it is now possible to invest in gold via ETFs. Interest continues to skyrocket. By contrast, the number of outstanding ETF certificates in the West is only just beginning to recover. There is still a lot of catching up to do. By contrast, the silver ETFs are still totally sluggish and there is no new interest. For reasons that have not yet been conclusively explained, the COMEX Metal Exchange in New York imports huge quantities of physical metals from the vaults of the London LBMA exchange. While gold and copper imports continue to rise, albeit at a slightly slower pace, the pace of silver imports appears to be accelerating. This is also reflected in the lease rate that investment professionals pay for leased physical gold. This recently fell to a more usual level of 0.16%. In silver trading, the lease rate is still more than 5%. The scarcity of available physical silver is thus accentuated. There is a very high correlation between the US dollar and the gold-silver ratio, as silver is also classified as an industrial metal. A stronger economy brings a stronger US dollar with it, but also a better performance by silver than by gold due to the higher demand. The current comparison suggests that the gold-silver ratio should fall. This would mean that silver would outperform gold. There is a high correlation between the gold price adjusted for the consumer price index and the silver price. According to this comparison, the silver price should rise towards 40 USD. Conclusion: even though gold has broken through the $3,000 mark, Asian investors continue to be big buyers in the market, although interest has shifted from professionals to private investors. In the West, investors are only waking up, and there seems to be a lot of catching up to do. But while gold is clearly the king, silver could become the champion in the coming weeks. Remember that these thoughts are not investment recommendations, but only our opinion. For recommendations, contact your own investment advisor. And thank you for watching this episode. I hope I was able to give you a few good thoughts for your investments. Don't forget to give us a thumbs up below to help us keep creating this great content for you. And don't forget, if you register directly on our Substack website, you will receive my next thoughts at least one day earlier. Check out the Substack link in the description, and best of all, it's free. I wish you great success with your investments and see you for our next market update.